Okay, we've got everything resolved now. Good morning, everyone, and welcome to our 2021 Economic Outlook series sponsored by First Merchants Bank and powered by our friends at Ball State University. I'm Brent Talcott, Regional President with First Merchants, and I'm excited to be hosting this Economic Outlook program where we will cover data and observations at the national level, the state level, and importantly to each of us at the local level. For a number of years, First Merchants has partnered with Ball State to bring economic forecasts to communities in East Central Indiana and more recently in Ohio. Now we are taking the next step by expanding that work across our entire bank footprint of Indiana, Illinois, Ohio, and Michigan. If you are new to these economic forecasts, you will see why we value this relationship and why we're excited to bring you the work of Dr. Michael Hicks and his research team at Ball State. As a distinguished professor of economics and director of the Center of Business and Economic Research at Ball State University, Dr. Hicks's research and insight has been reported in a number of national news outlets and publications. Prior to entering the field of economics, Dr. Hicks served his country in the Army Reserve, and he is proud to have two of his children following in his footsteps as cadets in the Air Force Academy and VMI. As Dr. Hicks covers his economic forecast, you will have the opportunity to submit questions to him. We will take the questions in the order submitted, so as thoughts arise, please go ahead and submit them through the Q&A chat feature on your screen. The current slide shows you what the Q&A icon looks like. And with that, we feel very fortunate to have Dr. Hicks with us here today. So without further ado, I'd like to turn the presentation over to Dr. Michael Hicks. Please go ahead, sir.
Thank you so very much, and sorry for the delay. What I'd like to do this morning is give you a quick snapshot of where the U.S. economy is, where the Indiana economy is. I'm going to compare the two, and then move into the greater Lafayette area. And so if I can have next slide, please. All right, and could we move forward to the next slide, Indiana economy? And then the first of this is the next slide would be the U.S. and real Indiana GDP growth. So what this graphic provides is both a historical evaluation of gross domestic product for Indiana and the nation as a whole. And you can see leading up to COVID or 2020's challenges with the pandemic, we had seen a significant slowing in 2019, both for the nation and the state. 2018 was a reasonably robust year, just under 3% growth. I want to contextualize this, that between the end of World War II to 2007, the U.S. averaged about 3.5% per year. So those years of growth, both in Indiana and the nation that were under 3%, reflect a fairly modest period of GDP growth in the U.S. economy, although labor markets were performing quite well. As we move into COVID, obviously, anybody who's been paying to the economy any attention understands that this was a period of extraordinary difficulty. Really beginning in the second week of March, the economy slowed profoundly. Spending in consumer areas across any of those face-to-face services plummeted by 60, 70, 80%, depending on which income category you observe. And that gave us the worst single quarter of GDP loss in history. And then a recovery in third quarter as businesses adjusted and households began to adjust their spending patterns. We saw the most rapid one-quarter recovery in history. And as we look at the full year of 2020, I believe we're going to see Indiana coming in at about 4.6% negative growth and just about 4.1% loss for the U.S. This is tempered a little bit by data that was released this morning. The GDP Now data actually had the fourth quarter GDP, the December part of it may be rising by 1%. So we may be as much as 0.2% better than this, given data that I observed this morning. And our projections in the Indiana econometric model for 2021 and 2022 have the United States recovering fairly strongly in the excess of 2% range. in this year. Of course, that's dependent upon the speed with which COVID disappears, where our assumption is that by midsummer, we're going to be returning mostly to normal. And then 2022 is going to look more like a historical year, which growth in Indiana down at about 2%. Next slide, please. Of course, that overall performance, which returns, we think, pretty much to normal by the end of 2021, normal being we're no longer being pummeled by the pandemic, but we're still facing a significant lag of employment, is this K-shaped recovery. And these data are from a group at Harvard called Opportunity Insights that track income, and we break it into three categories. And this really ends in early January. And what we see, November, what we see is a recovery that, a pattern of job losses and recovery that really impacted incomes, household by income very differently. So if you're in the top third of incomes, which is incomes a little bit over $60,000 per year, we're actually up. Those households are actually up for this year, about 1.2 to 1.5% by Thanksgiving. So this was a slow year of employment growth, not a catastrophe. For middle-income households, those individual jobs that are between $29,000 and $60,000 a year, we saw a loss of about 4%. So this is great recession level of job losses for middle-income households. And for the bottom third of households, these are households with or individual workers making under $29,000 a year. We see job losses between 19 and 20% as of mid-November. This is really Great Depression level job losses. So when we call that a K-shaped recovery, is really the top half are doing reasonably well, a modest downturn, and the bottom half of American consumers or American workers are facing once in a lifetime levels of employment loss. And that's going to play out as we go down the road regarding what we think recovery will look like for regions, depending upon the overall effect of the recovery on employment of this lower category. And you'll see some concerns that I have in that in a minute. Next slide, please, Deborah. This slide shows Indiana real GDP and personal income. And for 2020, we see real GDP down here in Indiana significantly. We see a recovery in 21 and 22 back to traditional levels. But the personal income for 2020 spiked. We are anticipating growth about 5.5% for this year or for last year, which we attribute to the CARES Act, the stimulus payment that started flowing into many households in April, and the supplementary unemployment insurance for the pandemic unemployment assistance and the pandemic unemployment emergency continuation payments, which were higher than typical UI through August. And so what we saw here is a fairly effective government stimulus program that in many ways helped better frame both the downturn, prevented a shift of a number of households onto other types of public assistance, and I think very importantly also provided a backfill for a lot of state and local taxes. Next slide, please. So in this next slide, we look at real GDP in Indiana and the COVID-affected sectors. And these are really the ones that we identified, and I think everyone else did early, as having both a great deal of face-to-face interaction, which would be affected by COVID, and of course, in finance, the expectations of households that there would be growth in households and businesses, that there would be growth this year that would spawn new investment. And so we see very large shocks to accommodations, food services, arts, entertainment in 2020, and then a fairly robust recovery, we think, for example, next year. Retail didn't do as poorly. American households shifted their consumption from services at restaurants and accommodations to goods. But even though we had a fairly good Christmas, retail sales were almost 12% below their 2019 levels in Christmas. So we're seeing fairly big shocks in those sectors as well, and a not very robust retail recovery in 2021 and 2022. I think that's pretty much what I want to talk about in that slide. Finance, I guess, rather important. Monetary policy obviously responded in early March, which was just a few weeks after the recession was officially determined to have begun in February. So we had, I think, relatively early monetary and fiscal policy compared to previous downturns where there were delays in both monetary and fiscal policy by as many as 24 months. We saw a very early and aggressive move by the Federal Reserve to reduce interest rates, and for some instruments are now below zero in real terms, particularly federal short-term bonds. And so what we're observing are that flow of capital through the transmission of monetary policy that would reduce the damage to the economy. If we look at the other sectors, the real GDP growth in other sectors, and these are ones that I'm saying are not particularly affected by COVID in terms of their day-to-day interaction. They were affected, but manufacturing, for example, the chief challenge in 2020 were supply chain interruptions, not demand for services. Utilities saw a modest bump. My concern in utilities here is that for a number of the data for 2020 may not be clear yet because of the stimulus, because of moratorium on removing customers from service who didn't pay. We might not have a really good picture of some smaller utility challenges, but for the larger utilities in the sector as a whole, 2020 went on fairly unabated. Construction was down in real GDP growth, although we saw a fairly strong housing market through 2020 as a consequence of the steep declines in mortgage interest rates that did exactly what the Federal Reserve wished them to do. And then other sectors, for example, healthcare, we would have expected that with hospitals full, that they would be doing better, but in fact, they did not. It turns out their most profitable sectors are not those in ICU or dealing with COVID, but in other areas. And so really no part of our economy escaped damage, but the more lasting effects, as I'll talk about in a minute, are really tied to the shock of face-to-face customer interaction in hotels, accommodation, and restaurants. Next slide, please. Just a quick summary here. I want to make very clear that we're in the midst of a deep economic downturn. This year is the worst there remain only 5 since we've been capturing data that is bad as this year. And that's really 1946. We saw a big GDP slump in 1945 and 1946 as we stopped making tanks and shifted into automobiles and homes. And then the other bad years that are comparable to this are really 1932, 1933, 1937. And so this is in, I think, real terms, very much like a Great Depression event, particularly for the third to a half of households where employment losses are really close to what we saw over a 2 to 3 year period in the early 1930s. So the peak unemployment for a year in the U.S. or a single month was just over 24% in the summer of 1933. And if we look at what's happened to people whose incomes are under 30,000, that's about where we are now. So it's a very, very deep shock to the economy. The vaccine brings optimism, but some of the damage to labor markets will be deep and lasting. So if we look at permanent job losses in the United States, they're back at about 2013 levels. And what that means is enough businesses have gone away in their entirety that it's going to take 6 or 7 years to work through that number of permanently unemployed through business creation. So the concern in the original CARES Act with the patient protection or the payroll protection plan and the direct household stimulus were designed to mitigate that, but we're really talking about moving back to 2013-14 levels. So it's going to take 5 or 6 years to work through that number. I do think we'll get back to growth by the end of this year that look like 2019, which was not a great year, but will certainly be better than this year. And I think it's going to take about a decade for us to get back to where we would have been had we not have COVID. So in many ways, the effect of this downturn is to knock us so far off our growth path that it will take us much of this decade to return to that. And I have some other thoughts that I think we'll talk about when we get to the regional economy. COVID is going to accelerate automation of service sector. So there'll be fewer jobs, I think, in service sector positions. And this will be most acute in restaurants where, such things as ordering and pay stations will be more obvious. But I think they're going to be broadly applied to service sector in ways that the manufacturing industry saw in previous years. I think we're going to have significant challenge to the experience of students. 30 to 50%, or early data suggests 30 to 50% of students have seen some deep learning losses. And I think those are going to weigh heavily upon this generation. I say that with a young man in high school who's been to every type of high school in the past year that there is, in person, cycled in and out, and distant learning. So it's been very difficult for them, much more challenging for younger children. College attendance has dropped by 5 to 7%. I don't think that's going to recover. Most of that is with young men who were already struggling in college. So young women look like they stopped going to college at about 1% below where they were in previous years. For young men, it's 5 to 7%. Obviously, the greater Lafayette region is centered by one of America's great universities, one of the world's great universities. And I think it's important that you understand that the effect of the downturn is going to impact higher ed and who goes to and who graduates from college there. And again, that the asymmetric impacts are going to deeply exacerbate the inequality. That's that K-shaped recession that we're all very worried about. So let me move on with the next slide to the greater Lafayette region. And Deborah, if you would, to the next slide. These are the counties that I'm looking at. This is bigger than the Lafayette Metropolitan Statistical Area, and each one of these counties actually see a non-trivial share of workers moving back and forth to Lafayette. Just a quick comment on this. The Metropolitan Statistical Area of Lafayette, Indiana, actually contains some fairly rural places. Benton County, for example, is rural by most anybody's definition, but not by the Office of Management and Budget, which defines metro areas. I think these counties really give a picture of where people are working in the area if they move outside of the region. And because of agricultural, many counties, for example, Tipton, will go in several directions, but there's a large agricultural presence there. And I do think it's important when you think about the local economy, for example, in Tippecanoe County, to think also more broadly about the counties that surround it. Next slide, please. Greater Lafayette GDP growth by county. So this is, let me explain this a little bit. This is GDP growth since 2010. You can see there's some places like Tipton County that have opened a very large new facility that have very large GDP growth. These data are in their first year of full publication. And so there may be some revisions coming down the road. The real story here, other than the shock to Tipton County of opening a one large manufacturing facility, is really the heavy growth out of Tippecanoe County. And so if we were to put this in dollar terms, Tippecanoe County is seeing a significant growth in the dollar value of GDP. And if we were to see something unexpected here, it would be Howard County's revival. That's Kokomo. There are one of the few very small municipal areas that are actually seeing population and employment growth over this decade. Next slide, please. So here we have the counties in the region. We have their population 2010, 2019. You can see, of course, that Tippecanoe County, the center of this region, is both growing fairly briskly and has the largest share of population. So almost all of the growth between 2019 and 2022 will occur in that county. It's being driven very much by economic activity surrounding Greater Lafayette. And this is not just Purdue, but Purdue University is, of course, generates much of this economic activity. It is also an attractor. A number of businesses, both high GDP businesses and large labor to capital ratio businesses, service sector industries, are attracted to a university town because the potential for human capital acquisition there. It's a fancy way of saying this is where people are that businesses that are expanding today would wish to look for are really growing. And I'll just say this because I think it's important for anybody who lives and works in a college town to understand that since 1991, the United States has created about 26, 27 million jobs for men and women, net jobs for men and women who have graduated from college. The country has created 4 to 5 million jobs for those who have a 2-year degree or have been to college and not received a 4-year degree. When it comes to high school graduates and non-high school graduates, net job growth since the early 1990s has been negative. So all of the employment action is surrounding those with college degrees. And this is not, as many would suppose, really underemployment of college graduates. There's very little evidence of that because all of the wage growth is also accruing in these areas. Next slide, please. I wanted you to see the types of jobs that are coming to the Greater Lafayette area. These are weekly new job postings. So throughout the last year, because there's some seasonality in this, including during the darkest parts of the the COVID downturn, we're still talking an average of about 900 jobs per week are being advertised in the region. This is an area of about 490,000 people. And so there's a significant amount of churn and potential new growth in the area. Next slide, please. And in this slide, I'm going to just, point out the most advertised jobs in the Greater Lafayette region. And you can see that much of the in-demand jobs, those jobs that are have a great deal of advertisement, are turnover in those sectors. So truck drivers, retail salespersons are fairly high, stockers and order fillers. But there's also in your region a significant amount of demand, increasing demand for workers with higher skills, registered nurses, of course, other healthcare facility workers. And so these jobs, there's a great deal of turnover in what I would call the, under 29 or certainly under $60,000 a year jobs, but there's also steady demand in healthcare, in technology. And if we were to go down, if I had plenty of slide space to look at the top 500 most advertised jobs, you're seeing some fairly highly technically skilled jobs. And the reason that those don't appear is even if they're growing faster than these other sectors, the turnover is much smaller. And it may also be that some of these jobs are advertised in non-standard ways that aren't picked up by the traditional job postings, for example, technology jobs with the university. And I'll just take a moment here to say that, one of the standout elements of really the Midwest since 2010 has been the growth of commercialization at Purdue University. And so we're really beginning 2010 and a couple of years after that, we've done work here at Ball State to evaluate where and how dense the commercialization of university research goes. And so there are a number of research universities in Indiana, really 5, that should have a great deal of commercialization, but Purdue is a national outlier in commercialization, and much of that is accruing to the Greater Lafayette area. And I think to some degree, even if it were to accrue to Indianapolis, you're going to see a tighter connection between the Lafayette and Indianapolis metro area over the next 2 or 3 decades. Next slide, please. So there are going to be 3 slides here. I'm going to look at what's called a shift share analysis. And a shift share analysis gives us a snapshot of the individual industries and how they're actually doing compared to national growth, what would be predicted with national growth, and the industry share mix tells us what would happen given our region's industrial composition. So the way this works is we have the actual growth in this first column for each of these sectors, and the bottom is the grand total, which we'll repeat several times here. The national growth, that's how much growth we should have had for that sector nationally. The industry share mix shows the difference between our experience and the national experience is really because we have less of this sector in that area. And then local competitiveness is really how much more or less we're having than should be expected given the national growth rate and the share of that sector in our region. And so what you can see here is in utilities, mining, extraction, natural resources, the greater Lafayette area is a modest job loser. In manufacturing, in particular, we're seeing a very large growth in manufacturing that is far more than we would expect given our industry share mix and national growth. And so that really, I think, points to the commercialization that's occurring around Purdue and the benefit of having access to the human capital at Purdue University and elsewhere. The region's doing poorly on retail trade. That's an experience everybody has. It's a little bit worse there than I would expect it to be, which means we may see some stabilization in the coming years. The next slide, please. And in this sector, we start moving to services, information, finance, insurance, real estate, professional management, and administrative and waste support. And in those sectors, right, we're seeing a movement away from finance and insurance. Part of this is due, I think, to consolidation in the industry that is moving it away from non-large metro areas, which is, part of the overall framework for financial services. And the next slide, please. This is the final education. These are services, education, healthcare, arts, entertainment, accommodation, food services. And these are all, by the way, pre-COVID. So we're talking about a decade in advance of the COVID experience, which we'll be able to update this time next year when we have better county level data on job changes. But you can see here again, the trade-off to some degree in the region between manufacturing and other jobs is that you're absorbing more of that. There's benefits to this. Among the benefits are the types of manufacturing jobs that are moving to this region are high quality, very high quality jobs, typically less susceptible to job losses than manufacturing in the past, and give us a more stable employment pattern or base for the region's economy. The downside is that some of these other jobs are amenity based and they provide the type of jobs that households like when they move to places. Very few households are looking for manufacturing jobs when they move. They're looking for retail and education and other factors. So as long as the greater Lafayette region is sensitive to those sorts of challenges, it should be just fine. And I'm sure there'll be questions on this in a minute. But let me go to the last slide then and handle any questions that you might have after I go through a brief summary. Indiana last year saw 24,000 new residents. If last year was similar to any of the past decade, 22,000 of those people moved to the greater Indianapolis area. And so a place like the greater Lafayette region, which is growing by just under 1,000 people per year since 2010, if you're getting 1,000 people a year in this region, you're one of the better performing metropolitan areas in the Midwest. And so unsurprisingly, what you're experiencing in this region is a very happy growth experience. That is going to continue through the pandemic. We're going to see urbanization, but it's going to be more geographically spread out. So I could actually see Tippecanoe County or the counties around it benefiting from this. There are, as we're experiencing now, a lot of people able to telecommute, and that would make living in a less geographically densely populated area like the greater Lafayette area more attractive. I do think we're going to see increased automation. So that's going to change demand for labor, not necessarily lose jobs, right? But we're going to see a shift away from, say, many services, restaurant services and, tip earning type jobs, as well as continued automation and goods producing jobs towards technology support in other areas. I believe the pandemic stimulus saved us from depression level tax losses at the state and local level. So the state's talking about having a tax year that's not far off what we had in 2018 or 19, which is much better than any economist predicted 6 to 8 months ago. And I think the stimulus largely did that. And I would remind everyone, my comment is that while things will look better this fall, and while many of us who are in professional jobs, who are watching this presentation, who are interacting with First Merchant Bank will have been fine. Many of our neighbors who are low income or have relied on providing service sector employment are going to face a far more stark challenge. And with that, I'll just stop and take whatever questions that you have.
All right. Thank you, Dr. Hicks. Obviously, the depth and breadth of research that you do at Ball State is impressive, and we've got a few questions in the queue based upon what you've shared today, and just other general questions that our audience has. And so, our first question comes from Garrett, and he asks, absent continued fiscal support with the reduction of taxes to state and local municipalities due to the lack of tourism and hospitality, what impact or challenges do you predict in the periods ahead?
That's a good question, Garrett. Yeah, so we think the stimulus spending, so we did a forecast last year that showed, significant losses. Some counties experiencing 20-30% loss in local revenue. The average county is about 4 or 5%, which is tough but doable over a 2-year period. Some counties, particularly those who were very intensely connected to travel and tourism, like Orange County or Brown County, we expected, very deep declines of overall tax revenue. And for states, double-digit losses for some instruments, but high single-digit losses as a percentage. I think in terms of the big tax instruments, the sales tax and the income tax, the stimulus saved the state. So we're going to have a lean year. We're certainly not talking about teacher pay increases. We're going to have a lean couple of years in local government everywhere. But for the three big instruments that are tied, the food and beverage tax, the innkeeper's tax, and then the gaming tax, I think the counties that are reliant on those are facing extinction level events for some types of funded activities there. So, the innkeeper's tax funds 40 or 50 convention and visitors bureaus. I wouldn't be surprised if those are halved by this event. Very difficult year for those sectors, but it's not isolated, it's everywhere. And so where that forecast could be wrong is that Americans may be itching to take vacations and to do things, so this summer may be better for them. But I do think we're facing real challenges in those levels of spending. And the best example of this, there was here in Muncie, we have a new hotel that's paid for with a TIF and innkeeper's tax, and that's really going to face a bond payment coming from general fund. So nobody is going to be immune from that pain, but it's not going to be, if you're not a major tourism destination, it's not going to be as bad as I thought it would have been 6 months ago.
Okay, thank you. Second question comes from Greg. He asks, across the nation, the amount of household savings balances have been increasing with more Americans holding on to cash. With the stimulus packages being offered and those yet to be offered, what is it going to take for households to resume their buying habits to pre-COVID levels? Or do you predict a new normal for households retaining cash?
Yeah, that's a very good question. Holding on to cash doesn't have a very good value now, as I'm sure everybody knows if you're looking at your savings rate. My guess is that the COVID really pushed Americans to spend a shift away from services towards goods, and that a lot of that was in home improvement. And so, which you don't have to be an economist to know, you just had to go into Lowe's in August to have seen what was happening in household patterns. We weren't taking vacations, we weren't going to restaurants, we were fixing our homes. My guess is that a relaxation of COVID restrictions this summer will see savings rates look more like they did in 2018, 2019. We would be better off if they did not, but I think there's a high probability that the end of COVID will make things look more like, at least in the short run, like they were before. And I hesitate to speculate on what the 5-year effect of COVID will be, or is this generation going to be like the Depression generation that really had with a combination of a world war and a depression, changed their patterns over a lifetime. I don't think we're there yet.
Okay, very good. Our next question comes from Tom, who clearly has some concern about our nation's borrowing habits. His question is, with the U.S. borrowing its way into oblivion, when will the effect of $25 trillion in debt hit the people of this country, and how?
Great question. So our federal debt is roughly about 80% of what it was at the end of World War II. The interest rate on our debt is really negative. That level of debt is concerning because if interest rates return to sort of a long run level, then they would consume, anywhere from 20 to 25% of GDP to make bond payments annually. That said, our share of debt is not, is well off places like Japan or China. And so we don't have the immediate size of a debt. It's mind-boggling to look at, but when you can pay a debt over 40 or 50 years at very low interest rates, it's not a big challenge. I was a budget hawk 10 years ago, but I think the lower interest rates and I think the apparent challenges to domestic infrastructure suggest if we were going to borrow, this is a good time to borrow. The real challenge isn't the debt, it's the level of spending that is not, and the composition of spending that's not moving towards productive activity. So if we had a very large debt that was allocated towards more productive investments, I think we would worry much less about the debt. The challenge is much of our spending today is aimed, to support people who aren't working instead of supporting people who are working with more productive enhancement. So the debt is bad. It's a concern, but it's not an extinction level event for the United States to have a debt of this magnitude. We've dealt with it before, but there's not real clear ways that we can grow out of it. Of course, there wasn't in 1946 either.
Very good, and somewhat of a follow-up on that. We have another question, and as you were just talking about the spending of our government and where it's going, the question was thoughts on another stimulus and the overall impact to the deficit. So I think you've answered part of that, but I mean, your thoughts on the proposed $1.9 trillion stimulus package?
Right. So I'm not confident that we need 1.9. I thought 6 or 8 months ago we needed another $1.9 trillion. It's less obvious to me now with the recession likely ending, or at least the immediate effect of COVID likely ending by early summer. Half of that would be welcome. The big concern that I have is that no matter how you play out the past year, we have had a shock to young people that is unlikely to be transient. And so I very much worry about the shock to learning for third graders, fourth graders, eighth graders. I very much worry about the loss of students going to college. This is going to affect many of them for a lifetime. And so as I think about what we should do for a stimulus, I'm less worried about saving existing jobs, which I think we're doing a fairly good job with this stimulus, and more worried about the extra spending we're going to have to do to mitigate some of the longer term effects of this recession that are just now becoming apparent. So I'm not afraid of a 1.9 trillion. Once you got a 25, 28 trillion dollar debt, another 1 or 2 trillion doesn't matter. The real challenge is, can we turn it into spending that causes productivity to improve? And so, I'd rather have a smaller stimulus and a bigger infrastructure bill, or a smaller stimulus and more remedial education spending for those students who were affected in many places.
Okay, thank you for that. We'll wrap it up here with one last question. And this one gets outside of the information that you've shared today, but one that I think is on people's minds as well. Taxes are a big issue, as we have a change in administrations and the potential for higher tax rates. What would higher taxes do to the stock market, in your opinion, as we move forward?
Yeah, I just preface this by saying if anybody could predict the stock market, they could easily be the richest person in the world in pretty short order. I like to think about taxes the way Milton Friedman is, that the spending dictates the taxes. So if you're spending at the level that we are, taxes will rise. Overall, the United States does not tax itself heavily in comparison to European countries. And so, we're top 40 or 50 on a per capita or a share basis. I think there's room for higher tax rates, but that's not really where I think the improvement would come. The improvement would better come not from higher tax rates, but from a more uniform administration of taxes. So I don't think there's any appetite for raising capital gains tax, or we're increasing corporate taxes to pre-2017 or 2018 levels. I think there's appetite for eliminating some of the loopholes that exist, which allow highly differential payments by different firms at different parts of their life cycle. So I think we'd be better off by flattening the experience for individual firms, even if we're going to have higher tax rates. And I do think, we're going to see a more progressive tax rate. Certainly the Tax Cuts and Jobs Act of the Trump administration created more progressive tax rates. But at the end of the day, we're going to have to cut both spending and increase taxes to prevent sort of runaway debt growth over the next few years, as we have seen for the past decade. And I think that's not going to help the stock market, but it really depends also on what that money is spent on. I think a stock market would react favorably to better, stimulus and more thoughtful analysis or more thoughtful taxation that treated entities more equally.
Okay. Well, Dr. Hicks, we've hit the 11 o'clock mark, and so I want to thank everyone for joining us today, and I hope you found this as informative and helpful as I have. We greatly appreciate the relationship that we have with each of you on the presentation today, and if you would like to discuss how any of the information presented here impacts your financial situation, please know that our entire team of bankers stands ready to help. Finally, again, a big thank you to Dr. Hicks and his team at the Center for Business and Economic Research at Ball State. We look forward to sharing more of his work in future presentations. I wish each of you a prosperous 2021. Be safe, take care of yourself, your family, your friends, and your business. Have a great rest of your day. Thank you.